Underwriting Battleground, Where Belief and Data Collide web seminar hosted by Valen Analytics and Farm Bureau Financial Services. I'm Kirsten Marr, VP of Marketing for Valen. We will begin by introducing our featured speakers. Steve Wittmuss is Commercial Vice President for Farm Bureau Financial Services. Steve has held several positions at Farm Bureau, including running specific business units and as a regional claims vice president. Steve began his insurance career at Farm Bureau Insurance Company of Nebraska and joined the Farm Bureau Financial Services organization in 2003. Matt Frazier is head of workers' compensation strategy for Valen Analytics, an advanced data and analytics company. Prior to joining Valen, Matt served as Senior Vice President of Sales at AmTrust Financial, where he was responsible for nationwide expansion of their workers' compensation product. He also held several roles at First Comp Insurance Company, including underwriting, marketing, and business development. Matt will get us started off with an overview of important market dynamics to consider as carriers look to improve underwriting profitability in workers' compensation. Steve will share how Farm Bureau has successfully implemented predictive analytics into the underwriting workflow. Matt, I'll turn it over to you to begin.
Thanks, Kirsten. So as we take a look at commercial lines, in particular workers' compensation, there are a number of industry trends that have recently come together that point to an increasingly complex marketplace. From 2005 to 2012, return on equity dropped from 10% to 4% for companies with a combined ratio of 100. And given the fixed yield investment maturities that predominate in most insurance carriers' portfolios, the low investment yield hangover most of us are still reeling from still creates some pressure to find ways to lower combined ratio. Now, we all know when ROE goes up, you have to make improvements in combined ratio to make up for that loss. The problem is exacerbated for companies with combined ratios over 100. According to the Insurance Information Institute, commercial lines carriers need to drop combined ratio by 3.6% for every 1% decline in investment yield in order to maintain a constant ROE. You can see on this chart for workers' compensation, the combined ratio number is even larger at 5.7, partly due to a longer tail and the typically longer investment maturities for that line of business. With an average 2012 work comp combined ratio of 110.4, it's no wonder that work comp carriers are increasingly focused on increasing profitability in underwriting. In fact, Ernst & Young, in their 2014 P&C Outlook report, pointed to the fact that the best performing carriers are leveraging data and analytics to refine market segmentation strategies across the board. What E&Y found is that pricing and underwriting discipline is proving to be a primary driver in improving financial performance. The word discipline here speaks to using better tools to promote consistency and increased rigor with regard to pricing, to risk, policies that need to be priced higher, and finding competitive advantage in some of those pools of policies that are significantly better than average. They also call out work comp as a line of business showing promising signs of combining strong pricing with moderating loss performance to drive underwriting profitability. Bottom line, there's a more sophisticated market emerging, which is creating a greater urgency for individual carriers to maintain their competitive advantage. Today, the market spells opportunity for those willing to embrace new analytics technology and possibly doom for those that are last at the lunch table. One place we see increasing sophistication is around risk selection and pricing. One leading indicator of increased market sophistication is the number of carriers we've talked to in the last couple of years that worry deeply about adverse selection and how in the heck to measure it. Notice Company B in the exhibit on the screen now. Company B has decided not to embrace analytics to better separate risk along the entire spectrum of available predictive characteristics, let's say. They underwrite and price based on the traditional approach, indicated by the horizontal line in the chart here. They maintain a conservative overall pricing and risk selection perspective. But better risks are largely subsidizing the worse risks within their portfolio. Company A enters the marketplace using a data-driven strategy, and using the latest tools systematically capitalizes on non-obvious risk characteristics. As a result, Company A's pricing strategy segments risk in Company B's portfolio in a way that systematically gives Company A the competitive edge for business that's shown in green here. Company A eats that market share. Company B ends up with the business in the black, or as it were, in the red at the pricing levels which the market is clearing at. Why? Because carriers with more sophisticated pricing methodologies win more of the best risks and do a better job avoiding the bad risks, or at a minimum, doing a better job of pricing to risk those exposures that are on the high end. Those bad risks end up being written largely by the competition at rates that are inadequate. Being able to identify whether adverse selection is happening to your portfolio is critical. And the sooner you know, the sooner you can take action to protect your market share. To put the situation into a predictive analytic frame here that we'll be talking about in just a bit, we often talk about deciles or bins into which these predictive analytic technologies will categorize populations of policies. The better risks are typically given a score of 1, 2, and 3, as evidenced by the graph on the screen there. The average risks, let's say a score of 4, 5, and 6, and the worst risks in a portfolio are given a score of 8, 9, and 10. This is just one way to think about a prediction or a predictive score. If a carrier's portfolio score overall is trending up, it can indicate adverse selection. If the pricing is not trending up with the portfolio scores, it may indicate rate inadequacy, or what I call adverse selection inertia, which, if not proactively addressed, can be the end of days for a carrier. This bin framework will come up again a little bit later as we start to dialogue about predictive analytic implementation. So let's take a look at how market share breaks out in work comp today. When you look at a quick snapshot that shows the distribution of market share by the 110.4 2012 average combined ratio, it illustrates how market share consolidation can play itself out over time. Today, 20% of the market is writing at an underwriting profit, and 44% writes at worse than average performance. For a moment, let's focus on these two groups. What are the top performers doing to achieve better than average results? What do they know that the other group doesn't? Well, the 20% achieving an underwriting profit know the risks that they're writing and retaining better than their competition, and they're able to consistently make better risk selection and pricing decisions. Additionally, they're successfully identifying pockets of the market share where they can build margin into their risk portfolio. The best performing carriers take their proprietary knowledge and infuse it systematically into their business operations with a focus mainly on pricing and underwriting. It's critical to note, lest you think that this is more about David versus Goliath than anything else, that the top 20 in terms of market share are actually fairly evenly spaced out along the continuum. 9 of the top 20 are performing worse than the average combined. This isn't about large versus small carriers. It's about who knows more about what they insure than their competitors. Now, this tells me that unless a poor performing carrier is willing to spend the time, the resources, and the technology knowing what they insure better than their competition, at the end of the day, they're going to be vulnerable to adverse selection by their competitors. And finally, what about the group of insurers in the middle? Here's the group to keep your eye on. If this group implements the strategies currently being used by the profitable group, they have the opportunity to steal market share from that group and also send their most unprofitable segments to the worst performing group. When we look at this 2012 snapshot, we see nearly half the market is poised to grab profitable market share or not. Which side of the moat is your carrier on? If you're in the top 20 of the market that's currently enjoying an underwriting profit, how will you protect your market share? Niche players will no longer be able to rely as heartily on their specialized knowledge. If you are writing at or above the average combined ratio, are you being adversely selected against? How do you know? Is your underwriting operation ready to embrace a data-driven test and learn, discover and improve ethos? How will you protect your book of business from taking on poor performing risks that your competitors are no longer writing? How will you compete for the better parts of your portfolio? Are you using your data to build a durable moat, or is the Trojan horse already in the castle? The race for market share is a natural outgrowth when industries become more sophisticated in customer acquisition, retention, and pricing strategy. The only question is, are you going to be one of the first to the table, or are you going to be one of the last? Now, the dynamic isn't new to insurance. If we look at personal auto, it's kind of the iconic example. Market share consolidation is already pretty much a done deal. 80% of the market share is held by the top 10 carriers. Progressive, as one iconic example, comes to mind as the first company in auto insurance that embraced new ways of using data and analytics to gain profitable market share in the non-standard auto business. Now, it's table stakes. Very few personal auto carriers are not using increasingly sophisticated data-driven strategies to defend, protect, and advance in the marketplace. Going after a risky marketplace, especially in Progressive's case, means you have to be confident that you know which part of the market will be profitable. Progressive was an early adopter of predictive analytics, like credit score, among other things, and that provided the confidence they needed in their pricing approach. They knew more about individual consumers than their competition did. Progressive was only too happy to share competitive rates with consumers, which allowed them to write business at the price they felt adequately covered their risk, creating positive selection for them and, unfortunately, adverse selection for their competitors who were quoting at a lower price on what Progressive determined were the worst performing risks. Geico is another iconic example. They leveraged their direct writing business model to offer lower premiums and dwarf the competition's advertising budgets, being able to allocate those advertising dollars in the right place to optimize the return that they were getting on one of the most significant advertising budgets in the industry. These examples provide a really great preview of how other P&C lines will evolve as data and analytics becomes more pervasive. Of course, we all know the examples in other industries of companies that outperformed their competition and became dominant market leaders. Google, Netflix, Capital One with regard to credit cards. The common thread in and out of insurance is the evolution of organizations becoming more analytically driven. A final trend that is top of mind for a lot of insurance executives out there that we speak to on a pretty regular basis is the need for the top talent. Insurance recruiting firm, the Jacobson Group, has reported that 50% of the insurance workforce is set to retire within the next 10 to 15 years. And that's at least 200,000 new positions that will be added by the year 2020. At the same time, McKinsey noted in a May 2010 report that 20% of specifically the underwriting workforce is nearing retirement, and they estimated we will need 25,000 new underwriters by 2014. Who's going to replace them? How are you going to translate that knowledge from your most experienced and tenured underwriting staff to some of the younger generation, some of the new millennials that are coming in? It's the younger generation, as 50% of the U.S. workforce will come from that millennial generation in the next 5 years or so. Before considering the needs around training a more junior workforce, the industry is pressed with the question, of whether this younger generation will see insurance, specifically the insurance sector, the P&C sector, as an attractive industry with exciting career potential. And as many insurers now lament, recruiting competition for analytics talent is fierce. Our industry is in competition with the likes of Facebook and Google and LinkedIn and Netflix and any other technology company that you can throw into the ring. Many studies have been conducted on what the millennial generation takes into consideration when making career decisions. On the screen is just a sample list of questions they often ask themselves about a specific job opportunity. We need a way to communicate that insurance offers an incredibly valuable service to consumers and businesses alike. It provides some of the essential fluids, some of the glue that helps society run, that helps it run efficiently and effectively. It helps facilitate home ownership and entrepreneurship through shared risk. And we have an incredible opportunity for bright, talented minds to innovate using advanced data and analytics to improve underwriting profits and to make durable an industry that at the end of the day is one of the major gears that helps the economy run. The macro trends that we reviewed today are just some of the evidence of a more sophisticated and complex marketplace. This more complex marketplace requires new rules of engagement for not only acquiring and retaining profitable business, but for better understanding business as we move forward into a brave new world. Kirsten, I'll turn it back to you.
Thank you, Matt. We're going to switch gears for a bit for a Q&A session with Steve Wittmuss of Farm Bureau Financial Services. Steve has a valuable example to share of how carriers can succeed using advanced tools in underwriting and across the organization. So Steve, let's start off by learning your story. Where you were at, how did you decide to start using analytics, and how you implemented the process. Steve?
Great. Well, thank you very much for asking me to participate today. Farm Bureau Financial Services is a regional property casualty insurance company, and we write business in 8 states. The majority of our book of business is in personal lines, but we do have a nice-sized commercial book, and we're looking to grow that book quite a bit. So we identify our markets as Main Street business. I think we were fairly typical for a commercial writer of our size. We did not specifically underwrite our work comp business. We underwrote the rest of the risk, and if we liked that part, we took the work comp. So a couple of things occurred to us. First, our loss ratio really blew up around 2010. So if you remember the chart they used earlier that showed the winning companies and the losing companies, we were definitely on the losing end of that. Our loss ratio was well above what our competition was. So while the rest of our book was profitable, our work comp was very unprofitable, so we knew we needed to make changes within our work comp book of business. Second, our underwriters had limited knowledge on what to look for when it came to underwriting work comp. If we didn't underwrite it as a general practice, they didn't have the knowledge to do that. So then the question was, how do we transfer the knowledge they need to underwrite the business to our underwriters? And if our only response to our underwriters was to tell them to go underwrite work comp, we were not going to be successful. So as you back up in my career, my first introduction to using analytics was when I worked with Personal Lines Auto. So I knew how predictive modeling worked. In Personal Lines Auto that I was involved with, we were able to level out our loss ratios by risk class with rate differences between the classes by up to 40%. So I knew if I found the right tool that predictive modeling would work for work comp too. Using data analytics allows you to be more efficient. You now underwrite by exception rather than by trying to write everything. So you can identify which ones you want to go after and which ones you can send through the process very quick. Even if you have experienced underwriting staff, they still only see a fraction of the potential risks that are out there in the world. And many times they never see the overall picture on how a risk is profitable. They just know sometimes if they've had a large loss or any loss on a type of risk. So that means underwriters work based on their rules and not necessarily always company rules or data and facts. If they had a large loss on a risk, they may exclude that type of risk going forward forever, even in the big picture if it was a good risk. So predictive modeling frees the underwriter to make that decision based on facts. So as a company, we decided to use predictive modeling, and now we have to introduce it. So when we introduced it to our underwriters, the first thing we did was start to tell a story. Here's our problem, here's what analytics is, and here is why it will help us. So remember to keep it simple, and graphs work better than numbers. So if you remember the example earlier where they talked about company A and company B and used that graph, I've been using that graph for a number of years to help explain what analytics does and why it's important for us to go there. When you introduce it, there will be pushback and there'll be outliers from the data. You can't hide from this, you just have to acknowledge it. So everyone out there has an example of somebody they think would be an exception. Just acknowledge that that person may be the exception, but he belongs to a group, and for the group as a whole, it is not the exception. Next thing you want to do is make sure you set up systems and processes so your staff can be successful. The actual underwriting decision needs to rest with the underwriter. Any tool you use, Valin is no exception, is just a tool. The underwriter still needs to make the final decision. Part of my background is in claims, and this is where you can get into a lot of trouble when the decision maker, you outsource that to a company or a process. So you want to make sure your underwriters are still the decision makers and use this as a tool and not a crutch. The other thing we did with this is we started off by focusing on the bottom 1/4 of our business that was unprofitable. So when they talked about the bins 1 through 10, we really focused on those bins 8, 9s, and 10s. So we built underwriting rules but gave the underwriters leeway on how to implement those rules in each of the bins. An example would be if the risk was in bin 5, they could use up to a 10% debit or a 10% credit, but it had to be in that range unless they got underwriting approval from their manager. And so on bin 9, they could use a 10% debit up to a maximum debit depending on the state. So we also recognize it will take a while to implement entirely within our book of business, especially on the renewals. You know, we have some businesses out there we've had a long time, and it's hard to raise their rates if all of a sudden they fall in the bins 9s or 10s, if they've been with you a long time and have not had a loss, say over 5 years. So you have to give your underwriters leeway, especially as you implement it, to have them get comfortable with the data and be able to use it. Then the last thing we did was shared our success stories. So in our case, we're able to show, within 6 months, we were able to show that those risks that we had that were in bins 9s and 10s, as a group, we were giving credits to them, even though analytics show that they would have been our worst risk. And after 6 months, we're able to show that now we're taking a debit on them. And so as a whole, it's making a difference. We're showing that to the underwriters, and they know that they're making a difference one policy at a time.
Thanks, Steve. So that's a good introduction to how to start introducing underwriters to analytics. Maybe now you can talk a little bit about senior management and why senior level commitment is so important, number one, and number two, what does it take to really secure that level of commitment within your organization?
Well, this is no different than any other major project. It has to have key support and proper resource allocation from senior management, and it has to cascade down through all the various levels of your company, whether it's communication, the IT resources, or even a willingness to sell the program. As I mentioned earlier, there'll be pushback in multiple areas. So I've identified 3 of them. The first one is underwriters. You're going to get pushback from your underwriters. First, you're challenging their knowledge. You need to let them know that instead of challenging their knowledge, you're giving them additional tools that will help them better understand the risks they are underwriting. And again, this allows them to manage by exception. So instead of you telling them that they have to work harder on all their underwriting risks, for, in our case, work comp, you're identifying, here's the band that we want you to work with, in our case, the 8s, 9s, and 10s. The other ones you don't need to spend as much time with, so you're stair-stepping them into it and allowing them to spend their time on the risks they need. Second, as I mentioned earlier, you're putting them in the middle of the renewals and the insured and the agent against the data. So I think you acknowledge the issue and give them time to move at less than full speed towards implementing on renewal business. But as we've seen, once they know it's working and once they see the success, they've increased their usage. The second group you'll have pushback from is agents. So, you're changing the rules, so you need to be able to tell your story, need to twist it towards them. In our case, we have captive agents, so it's probably a little easier for us to introduce it and not lose the business. I know if you're right in the independent market, that may be more of a challenge. But we had to actually stop our quoting process to make this happen. Prior to implementing Balun, our agents could go in and quote and rate all within their operating system on their computer without having an underwriter get involved. Now, since we started Balun, so we could get it in quick, we've made it so that if they're doing work comp, at a certain point it stops them and tells them they have to contact their underwriter. Their underwriter then runs the Balun report, and then it gives them the amount of quotes. So we've really changed what they had to do, but we've told our story. We've explained to them what we were doing, how much money we were losing, and they bought into it. We've also explained to them our long-term goal is to make that part of the process so they don't have to stop in the midstream of rating. Again, with agents, they're always going to know somebody that's the exception, and that's just something you're going to have to work through. The third group that you're really changing is the client, and you're moving their cheese for some of them. So first, remember that you're only changing some of them. There's a number of them where the rates will go down or their score will be such that their rates could go down. You won't hear from this group. What we have found is when a client searches for new coverage because they're interested in leaving us because we've raised their rates, often they stay with us because we're still competitive. If we were extremely underpriced in the market, us going up a little bit is not going to change that the first time through. Now, hopefully, as we keep moving forward, their rates will continue to go up until they're paying the proper amount for their risk. And third, you just have to have faith that you trust the numbers and the data, and that if you lose business, it's going to another company that's writing it at a loss.
Thank you. You touched on this a little earlier, but I thought it might be good to discuss what you think are some best practices when you start to implement predictive modeling practices. Perhaps you can share the Farm Bureau process and approach.
Sure. First, we engaged our underwriting staff early and often, and we try to do that as often as possible on any project, give them advance notice well in advance what we're looking to do. So in our case, we needed to explain predictive modeling. We did that. We started talking to them probably in September when we got serious about working with Balun and knowing we were going to go there. And we implemented it the following March. So this gave our underwriters time to get used to the idea, plus it allowed us to use the underwriters to help develop our processes. We also, again, I talked about, we went with the manual process so we could get it implemented sooner, and I think that's a benefit too, as opposed to letting it drag on. So after we engaged our underwriters, we made the decision not to change more than we could handle. So we started with the minimum we thought we needed to be successful, and then we figured we could work on the rest once we got some victories. So as I talked about, we focused on those bins, 8s, 9s, and 10s. We developed rules that still give the underwriters the ability to make the decisions. However, to show we're serious and want to stay engaged in the process, if a risk falls in the bin 10, they have to have sign-off from their manager or myself before they can do anything with it. And that's whether they keep it the same, whether they give it max credits, or whether they get rid of the business. So they have to participate, come to us as management, and we're part of the decision from that point on. In addition, we required it on new business right away, but again, we gave them a little more leeway when it came to renewal business. The next piece of the puzzle would be training. So we have a very specific process that we use for training on any new process we introduce. So first, we start by developing what we call as a job aid. And this is a step-by-step instruction on how the process will look going forward. This is an important first step as it keeps all future training grounded to this document. If changes need to be made to the process as we go forward, we must come back and change our job aid. Once we have the job aid written, then every month we have a 1-hour call within our department, and we usually do this with 3 20-minute segments, so they're a little longer segments, And when we have a change like this, we take one of those segments and we announce the change along with why we're doing it and what it means for our staff. This ties back to that senior management because it's usually myself or somebody else at my level that's giving the introduction, so they know that there's support behind it from upper management. Then after that meeting, we have a 1-hour training session, and the training flows from our job aide to the staff. If needed, we can schedule additional training after that, but we always start with a 1-hour training session. Then once the new process starts, we just have one place for the staff to go with their concerns or problems. So that way we can see if we have a systems issue, a problem that's becoming a trend, or is it just staff that needs time to adjust and they're just kind of talking through the process. It also provides a consistency with the information we provide back to both our agents and underwriters. We think that's very important. The last thing I'll talk about is finally is that I have my own 6-week rule. So after a launch, immediately I check with some people to see how things are going, get their view on how things are moving forward. Then I kind of check back against in 6 weeks with that group to see how they're doing. That's when I see attitudes usually really start to change. Short of a catastrophe, I try not to make any significant changes to a new process or program until you can get that 6-week mark and see how that's going. So as a manager, I just think it's good to have some informal checkpoints.
Thank you, Steve, for sharing that. Of the dozens of carriers that we work with, I think we've seen from Farm Bureau that your process has been incredibly successful. So, thank you for sharing some of the specifics with our audience today. Next question for you. What are different ways that carriers can think about measuring success and underwriting improvement?
Yeah, for measuring success, for us, it's been easiest to track our renewal changes. So you take what you had in the prior year and compare it to the current year and see what you have. So for us, in the first 6 months, I can give you our numbers for what our book of business has done. I can track it by company-wide. We can look at how the data is being sorted by bins. I can see what we're doing with each bin. We can see how we're using the data for scheduled rating. I can also see how the premium has changed. So I can show you how our underwriters are using the tool per underwriter on the renewals. I can also, as I said, I can tell you about the amount of premium increase we have seen, as this alone has paid for the program. For us, new business has been more of a challenge. We continue to look for ways to do that. We're just starting to get reports on that, and that's more of us trying to understand the process and how we can track it best. Again, we got it in a very short period of time, in 6 months from the time we really got serious with Valon. We signed the contract at the end of December, and we were up and running by March. So to get everybody on board and to see everything, it's taken us a little bit of time. So our loss ratio has improved since we've implemented the process, but it's only been a year, so I doubt that was due directly to the data this quickly. But what I do believe is that we have an awareness down by our agents and underwriters that we have an issue with work comp. And we've gotten rid of a number of poor performers already because of that awareness. So we believe it's making somewhat of a difference to our loss ratio even this early. One other way that this has helped, and again, I'm not sure how you measure it, but it's underwriter engagement. So we talked earlier that said our underwriters, prior to using Valon, we'd never really underwritten work comp. So our underwriters are really concerned about having to do so. But what you see now are underwriters out there, and they're discussing work comp as a group. They're engaged. They feel confident they can make good decisions. They're interacting with our product staff and our risk management staff. So by sharing our successes, we are having the underwriters see that they are making a difference, and their enhancement or their engagement on this process is really skyrocketed.
Thank you, Steve. So just to recap a little bit of, what you shared when you decide to implement analytics, tell a story, keep it simple, begin, in a small way, make sure that you've got senior level commitment on board so that the project can be successful and get the resources that it needs. And as you evolve your underwriting organization, engaging the team early and often seems to be one of the key reasons that you've been successful, along with the very defined process that Farm Bureau uses. And then it seems that you're using measurements that are both hard measurements that say, hey, we're already getting a return, but also looking at different wins in terms of underwriters really, getting on board with thinking about how to underwrite work comp, et cetera. And there are multiple ways to kind of measure the results that you're getting early on. So thank you for that. We are now ready to open this up for questions. We have a couple coming in already, but we'll give the group just a moment to type any questions that you have in the question box. So I'll just put things on hold for maybe 60 seconds, allow you to put some questions in, and then we'll get started with our Q&A session. Okay, well, please continue to put your questions in. We have a few to get started with. The first one, Steve, is for you, and then Matt, you feel free to weigh in. The first question is, do you have a compliance tolerance? And I'm assuming that means in terms of underwriters complying with what the predictive scores are indicating on a policy for both risk selection and pricing. So maybe you can talk a little bit more about that.
I'm sorry, can you repeat the first part of the question?
Yeah, do you have a compliance tolerance for underwriters?
We haven't developed a compliance level right now. We do audit our underwriters and follow up with them. We have actuaries that have gone through. We just did a review and found a number of files where we're missing the reports and trying to put those up together. One of the things when you talk about the compliance, we've really told them that on new business it needs to be there. That's where it really does. We batch order the renewals, so we have all the renewal data. It's how they use it.
And I would just add for a moment on that, it really depends on where your organization is on your predictive analytic journey. If you're very, very new to predictive analytics, getting the underwriters on board and involved very early, and then I can't stress this strongly enough, and that is that having a system beginning with the end in mind with regard to monitoring, measuring, and managing the decisions that are actually made by underwriters relative to the predictive scores, and being able to show them exactly what is happening in 12 months and 18 months and 24 months with regard to the exceptions that they're making to the predictions will not only help foster underwriting adoption and engagement with the predictive analytics that they're receiving, it will also provide to the organization as a whole a systematic framework of feedback loops so that you can then thereby improve the predictive analytics at the end of the day as well.
Great.
One more thing I'd like to
Sure, go ahead.
One more thing I'd like to add. The other thing is you not only have to share success stories with your underwriting staff, we've had to share it with other management within the building. And so one of the things when you talk about compliance and going forward, one of the things we've been able to measure is the lift in premium. As I mentioned, just the lift we've had in premium has paid for the program, and by communicating that, you get a little more leeway too on how fast you have to implement it. And so that's really helped with our end too.
Yeah, that's really helpful. There's sort of a follow-up question. Steve, you sort of mentioned, if we're in bins 8, 9, and 10, or certainly bin 10, underwriters will have to go to their managers and ask for an exception. The question is, are there levels of tolerance in terms of the changes that you underwriters might suggest that you would approve, and do you struggle with underwriters trying to exceed those numbers that you set and thereby perhaps hurt your retention?
So no, our underwriters are really good at staying within the boundaries, and we've given them wide enough boundaries they understand that. So I don't see that has been a problem. As far as working with underwriters, one of the things we look at when we're trying to decide if we want to go outside of what we've identified the underwriting rules are. You look at other things. Do we have other business with them? We're a multi-line carrier, so you look at how many other products are out there. You can find out, do a background search on them, check the internet, see those kind of things are going. You can kind of get a feel. So it still goes back to that underwriting piece. Working with management, again, they have to come to us when they're outside the guidelines and on all 10s. But all 10s are guidelines, or you have to take the maximum credit or you have to get rid of the risk. So anything keeping them less than that is what they're coming to us for. And most of the time, about half the time, they're coming to us to do something, but it's because they've been with us a long time and probably not a lot of losses. And so they want to stair-step it more than they want to avoid going that direction.
So the one addition that I would probably add on is just to think about the fact that predictive analytics and any prediction that is being placed in front of an underwriter really has a soft benefit associated with it, and that is to get the underwriter to think twice about risks. I mean, I was an underwriter for a while. I've talked to lots of underwriters, and the one thing that you get consistent assent to is, hey, we are transactionally oriented, and sometimes we might turn our brain off just a little bit without thinking about it. We may be making pricing decisions or some risk selection decisions that are, in fact, unconscious. They're just, putting the stamp on the piece of paper. And the prediction does a great job of at least getting them to think twice about things that fall into bin 9 and bin 10. So even if you are, operating within an organization that is not ready to be prescriptive about whatever thresholds that you're going to place on the underwriter, at a minimum, as long as you are, as I said before, measuring, monitoring, and managing the decisions relative to those predictions, you can actually involve the underwriters in setting those thresholds. And I think that's a really important point, that you work with the underwriters so that they are setting their own thresholds while at the same time still feeling empowered with regard to using predictive analytics as a tool, not something that has been sort of beset upon them that is limiting, quote unquote, their freedom or flexibility.
So we have lots of great questions coming in. Keep them coming. Steve, another one for you, and then Matt, feel free to weigh in. Do you find that many policies have a large change in bin score from one year to the next? And if so, how do you handle that?
I can't really answer that because we're just starting our second year. And so what we've seen is, what we were writing previously to what the bin score is, we've seen a lot of change. But I'll have to defer to Matt on that.
So, I mean, the simple answer to that is yes. There are certain things, especially if you have a, let's say you've got a risk that had no losses and then all of a sudden a whole spate of losses. The real question is that going to move from a bin, let's say a bin 1 to a bin 8 or a bin 2 to a bin 10 or something like that? The answer to that is that's absolutely a possibility given whatever predictive analytic model you have in place, whether it's considering things like historical frequency and what your overall portfolio of business looks like if you're running small accounts versus large accounts, etc. So yes, that's absolutely probably going to happen, and it may happen with some degree of frequency. The way that I have seen carriers successfully deal with that is to make sure that the underwriters understand that a little prediction goes a long way. It's not the case that you have to run from a 20% credit to a 30% debit on a particular account. But if the underwriter is forced to think twice about whatever that move looks like, it allows them to evaluate that policy more critically with a little closer, critical eye on the inputs that are going into the model. And they're actually going to, over time, understand how to underwrite that policy better with regard to the use of the prediction. That means that if historical claim counts or claim amounts are an input to your model, it means that the underwriter is going to think about those differently. They're going to ask themselves, has that was that input derived from an event that came from a discontinued operation? Is there now a guard on that machine that was causing those losses? They think about it very differently than having to do the relatively poor mental math that we as humans do with regard to, how does this frequency matter with regard to the weight that I'm applying to that frequency versus severity versus loss ratio versus class code versus premium size, blah, blah, blah. So they start to think about it differently, and it's not the case that they need to take a 50% rate increase. It may be the case that they've got a good reason for deviating a little bit from that prediction, but they're not going to put a 20% credit on it. Maybe they're only going to put 10% credit on it. And being able to, again, measure, monitor, and manage those increases, whatever they look like, they're going to produce some advantage across the entire continuum of scores that underwriter has across their portfolio that they're responsible for.
Again, the personal lines auto that I was involved in, when they had a change, a significant change, they limited that change to a couple, in this case they had more than 10 bins, but they limited it to a couple bins is all it could change to. And so when they went to make the change, it would start moving in one direction as opposed to another. But following up, last thing with Matt, when he talked about having that discussion, that's where you also need some other tools in your bag that you can use. So that's when you can talk to the insured, talk to the agent, get them to understand the problems the insured's having, see if you can turn that around. If you have risk management tools, you can move the insured towards, try to save that account long term.
Great, thank you. So we have another question. Maybe Steve, you can weigh in first. Do you rescore accounts midterm as a result of policy changes, for example, endorsements, and change pricing as a result?
No, we do not. We do it just on renewal, when it's new and on renewals.
I think there's a little bit of a slippery slope there with regard to endorsements that actually can happen. It really depends on how you've built your predictive model and whether the target of that predictive model is at a discrete annualized policy term basis or whether you've done something that is a little more granular, whether you're looking at it over, let's say policy term month of a particular policy life cycle. What I would caution people against is making changes like that in production if you haven't fully recognized the variability within a given policy term when you built the model so that your target takes into account some of that variability that may occur, where it occurs, what the distribution of those occurrences are, and some things like that. It does get into some pretty complex considerations when you start to look at, gee, should we be running a new prediction on a monthly basis across, all of the policy terms within our portfolio? There are some pretty dynamic things to think about there that can have a fairly large impact. So be careful doing that in production if you have not fully evaluated some of the impact of the complex interactions in the modeling framework that you're working within to build your predictive model at the outset.
Great, thank you. So we have some more questions. Steve, again, I'll throw this one to you first. Do you currently have system-driven underwriting rules? If so, how has the approach to business, to the extent that it exists, impacted your processes and your workflow? And maybe how has the incorporation of analytics and predictive modeling sort of affected that underwriting workflow?
On the front-end underwriting, we do not have system-driven underwriting rules. So everything we do on the commercial side would be manual rules that our underwriters apply. On the back side, when we go through the renewal process, we have some underwriting rules that would help us order reports. Then when we order them, based on the criteria, again, if it's an 8, 9, and 10, they would go to the underwriter. If there's, for that call out, there might be some other call outs too, but specifically for that call out. If it's a 1 through 7, we can just underwrite that business and send it out without an underwriter having to look at it if there's no other underwriting call outs on it. So front end, with our underwriters, no, it's not system. On the back end, we do have some system rules with it that have taken some business off the underwriter's plate on the renewal end.
I'm going to add something pretty short. It's a really good question that could blossom into a very substantial, complicated answer. Depends on whether you're doing straight-through processing or whether you're not doing straight-through processing. My experience across a pretty wide variety of carriers is that those who are engaged in developing a sort of best-of-breed straight-through processing or expert underwriting, it actually becomes significantly easier because A, you can evaluate the rules you're using within a predictive analytic framework to find out whether those rules actually have efficacy. You can toss out the rules that are not predictive, you can add rules that are predictive, and then you can start to look at things multivariately and make things a little more continuous than they otherwise would be if you're just throwing some rules at it that were developed by, let's say, underwriters based on arguments from authority and tribal knowledge. You actually get to test and learn, and you get to throw out what doesn't work. There's a lot of different ways to kind of go with that. The other one is I think it really does promote underwriting adoption if you sit down at the beginning of a predictive analytic project and you say, let's take a look at our current underwriting rules and let's see if we can evaluate those from a predictive analytic standpoint within the exercise. That way, we can find out whether there are rules that are better and there are rules that are worse and there are rules that are just bad rules and we need to throw out. What that does is promote a little bit of intellectual humility within the underwriting organization so that they are, quote unquote, ready to be students of the process. They're ready to learn. They've got enough empirical skepticism that they believe that the predictive analytics is actually going to help them grow and become better underwriters than the competition.
Great. So Matt, I'm going to throw this question to you first, and then Steve, if you want to weigh in as well, that'd be great. So how does the score adjust given a single state policy and then one with multiple states? And then it says, let's see, and to that, if there's a single state policy score, does the model score take into account possible increased benefits when all states coverage is affected?
It's a great question. The answer really depends on what kind of model that you're working with and the levels of the data that you've aggregated up. We have built models that are essentially ensemble models at the state level where you're actually generating a state score and then you're rolling it up on some premium weighted or exposure weighted or other weighted basis to the policy term level. The other easy way to do that, if you've got, let's say, a prediction that is operating at a policy term level, is to score those things at a policy term level and then break up the single state constituents and score those individually. We have a lot of carriers that will actually do that second method, especially when they're looking at, let's say, large multi-state policies where they may have some sort of an advantage with putting one state in the assigned risk pool and writing the rest of the risk at some competitive rate. Because a lot of large account writers actually look at their policies that way and have relationships with their agents that they can ask them to make those considerations, they will actually score at the policy term level, generate a prediction there, and then they will take each of the individual state constituents, score them there, to just get a more granular understanding of the risk topography across those different jurisdictions. The second part of your question, if you've got a model that is being scored at the individual state level, then it should be typically and taking into account different jurisdictional and benefit level considerations, along with certain rate adequacy considerations relative to increase or decrease benefit levels and jurisdictional differences. To the degree that you've got a policy term prediction and you're generating one prediction on something that has multiple states on it, it really depends on how big it is and how much those jurisdictional differences matter with regard to the predictive framework relative to all of the other information that's available on a large risk that has some pretty robust historical loss information to be able to dig your teeth into. There's no single good answer. There's a lot of reasonably good answers.
Steve, you want to weigh in or add anything to that?
No, I think you did a nice job.
Great. And then one final question we get a lot, which is for Steve, which is when you're deciding to implement analytics using internal teams and data versus using external vendors like Balance, how do you assess making that decision and kind of what goes into your decision-making process?
Well, in our case, we had to decide if we had enough work comp expertise within the building to do that. And as we started this, again, we wanted to get in it really quick. If we wanted to build it and take a couple years, we would probably be able to do that. It would take some programming time. It would take the ability to dig back into our policies. For us, a vendor like Valen was perfect. They've got a big universe out there of risk. They understand the market. We're able to tap into it quick and go forward. We could set up rules around it really quick and get it up and going. I've mentioned them. I'm not sure our external vendor, and this goes for any line you're using, I'm not sure how long-term it is versus at some point I'm sure we'll try to integrate it and do it in-house. But for getting it started, it was very important for us to get going early, so that was a big deal. We didn't have the expertise on how to get it started quickly. Certainly we have expertise in here and could have learned it going forward. But if we wanted to get it up and started, 6 months basically from the time we really started talking to them, the time we were up and running, which is an unbelievable speed to market. So those were some of the big deals. We go there. They're keeping track of their talent. We are using, when I talk about some of these reports that we're talking about, we have our own staff developing some of these reports in the background, so we're not just dependent upon our vendor to give us reports.
Great,
Matt, I don't know
thank
if you
you.
have anything.
No, I think you did a great job. I have nothing to add.
That was good. Well, we are at time, so I want to thank Steve Wittmuss from Farm Bureau for presenting with us. Thank you, Matt, for all the industry insights that you shared. For everyone on the call, we will send out the recording and the presentation tomorrow, so look for that in your email. And thank you all for attending and spending the time today.